right, so this is the Boeing VIP, the voluntary investment plan, the investment options that are offered through there. A good friend of the channel had emailed me this stuff on the Boeing plan, and I thought it was pretty interesting to look at. So let's dive into this. Remember, first and foremost, you do have the Boeing stock fund. All right, the Boeing stock fund. I just say be careful there. And in fact, I would say you probably should shy away from it, frankly. Because if you're working there, you already are affiliated with a company, which means if the stock goes down like we're witnessing now, not only is your job more likely on the line, but your retirement is on the line too. So it's a twofer. You're putting two sorts of risk into the company, and the company risk your job, and then the company risk in the retirement portfolio. So just you gotta be careful there. I'm not a fan of that, but do what you gotta do. All right, so we got Lifecycle retirement funds. Let's just keep going down here. Lots of disclosures. Look at all the disclosures. No one reads the disclosures. Okay, here we go. So we got the Lifecycle retirement fund. It says if you're at retirement or near retirement, you're gonna have about 5 to 10% other. It looks like 10% or so in non-U.S. stocks. It looks like 30% or so in U.S. stocks and 40 to 45% in bonds. So that's a little bit more aggressive than I would have thought, but I don't have any problem with that. And simply the reason for that is because just because you're at retirement doesn't mean you're not going to be around for another 20 to 30 years. All right. So, and that's why I want people to understand. Just because it's retirement, you're at a retirement fund and a target date fund. These are target date funds. Doesn't mean you're not going to have any stocks. In fact, you're still going to have a good amount of stocks, as you can see here. They still got about 40 to 45% stocks, and the other could be real estate investment trusts. I don't know. So just be careful there. If you have a target date retirement fund, and the target date is today, you're still going to have a lot of stocks in there, and that might not be what you want. I'll leave that up to you to decide for sure. All right, BlackRock runs it, so the fees are low, 28 basis points for an operating expense. I mean, you can't beat those fees for sure. Hard to say what the performance is simply because it as you get closer and closer to retirement, it gets less and less aggressive. So I don't really care much about the performance simply because it's fluid, if that makes sense. It's not static, in terms of we're beating this benchmark. The Wellington, we know it's 70% stocks, 30% bonds. We know it has a benchmark right there to compete against. That's not going to be the case in these funds, and I'm very okay with that. But let's go down, keep going down. We got the, lots of disclosures. The Lifecycle 2020 fund. So this says, look, if I'm going to retire next year, this will be the fund I want. And this will tell you it's exact same thing we just told you about before. So when you got the target retirement fund, it's going to be more heavily oriented towards bonds, but still a decent stock exposure. The Lifecycle 2020 fund will be almost identical to that fund, the retirement fund, just because it's saying you're going to retire next year, all right, or you're close to retire. Now, I want to point out something too. Let's say I'm 48 years old. I'm working at Boeing. I plan on working for another 20 years. We'll just say that for example. That does not mean you can't have this fund. You can. I'm not going to retire until 2040. I can't have the Lifecycle 2020 fund. Yeah, absolutely you can. Just means you're willing to be more conservative. Does that make sense? You can certainly have any Lifecycle fund you want. You're not locked into the Lifecycle fund. It's really just a choice of how much risk you want to take relative to stocks versus bonds. So if you want to take less risk, you get a sooner 2020 fund or a retirement income fund. If you want to take more risk, even if you're about to retire, you get a 2050 fund or something like that. And we'll go into that a little bit more. All right. I imagine the same thing. The expense ratio, 29 basis points. You just can't beat that. All right. So let's keep going down. Imagine it's going to be the 2020. All right. So yeah, they got all these different funds, 2025 fund, the exact same thing. The longer until you retire, the more aggressive it will be. And even this guy is 10 years out. It's still got it looks like 25 to 28% bonds. So this guy is not even 10 years out. It's 8 years out to retirement, 6 years out to retirement. It's still got I guess about 40. About 40% in bonds, 42% bonds, 60% stocks roughly. That works for me. That's a 60-40 portfolio. So Lifecycle 2020 fund is going to be a 60-40 portfolio. I got no qualm with that. Let's keep going down. See what else they got here. We got 2030 fund. I'm just going to pass over these Lifecycle funds. The way I look at it, I'm just going to go to one here real quick. Let's go to 2040, I imagine. Yeah, here's a 2040. All right, so here's a 2040 fund. That says you're 20 years from retirement, so they're going to give us this right here. this in the middle, and it says we're 20 years from retirement. We're gonna have that's about 20% bonds and 80% stocks and other, and I guess other would be real estate investment trusts or commodities. That's more like it. I'm much more a fan of this stuff right here than I am the other, simply because of bonds, there is no value there relative to growth. There's not. That doesn't mean there's no value relative to stability. Just relative to growth, there is no value. Because bonds, after taxes and inflation, you're literally losing money. I mean, again, I just did a look at it. I'll show you again. I just did a video where I talked about paying off a mortgage or investing it, and I'm going to show you. This is if you see that TNX right there, TNX, what does it say? 2.48. That's a 10-year Treasury bond. So you could lock up your money for 10 years with the U.S. government, no risk. You only get 2.48% a year. So after taxes, inflation, you're losing money. All right, 2045 fund. All right, let's see what other funds they got. 2050 fund, and I imagine the 2050 fund probably doesn't have any bonds in there. Yeah, so if you're 30 years from retirement, you're gonna have 5% bonds or something like that. So I like that. All right, let's keep going down. 2055 fund. Yep. All right, bond market index. All right, so I'm not a fan of bond market index. All right, I'd rather have the Lifecycle fund. The reason for that, let's tell us if it says how. Look at that, 3 basis points. That's pretty good. Bonds, 98% bonds, and the Morningstar sectors. But what's the whole? Yeah, okay. So these are the holdings right here. Treasury notes, Treasury notes, Treasury. I mean, the bond index. 70% of bond index holdings are going to be U.S. government debt. All right, 70% is going to be U.S. government debt. Because of that, you're just not making much money, because I just showed you what U.S. government debt is paying. It's not paying much. Now, look, that's a wonderful place for you to sit there and say, look, I'm getting ready to retire in a year or two, and I don't want to get lumped before I do. This is a good place to be, without question. But you're not going to make any money. I mean, just not. So just be careful, right? And so we got government, and you'll say, well, that only says government. It's 42% is government. Well, 30% is securitized, which is going to be mortgage-backed securities like the Ginnie Mae, Fannie Mae, and Freddie Mac's, essentially government-sponsored entities, GSEs. All right, so between these two, there you go, 72% is going to be government and government-sponsored entities, government bonds, no other way around that. So this would be a good fund only if you want to make sure your money is locked in for the next 2 years. You don't want to lose money, and you're willing not to make any. This would be a good fund for you to be, for sure. I mean, but look, 3 basis points, you just can't beat that. All right, let's keep going down. The index fund, all right, imagine, all right, there you go. It's S&P International Index and Bond Market Index. Let's see what it tells us, how much of it. Oh, there you go. U.S. stocks, 30, non-U.S. stocks, 30s, and bonds, 40. So 60, 40 stock to bond ratio of 30, 30, 40, international stocks, U.S. stocks, and bonds. So, I mean, that's pretty good diversification for sure. Man, I got no problem with that in the least. None. Look at the 5 basis points, incredibly cheap. So you got 60-40 with 30% of that 60 being, well, half of that 60% being in foreign stocks. I mean, that's not a bad place to be. Balanced index funds, be done with it. Again, I don't like bonds. If I need growth, I'm not going this route. I'm just not. But let's keep going down. I like it. S&P 500 index. The only drawback here is I tell many people is that only has large cap stocks, large cap U.S. stocks. It has no small, it has no international. And my preference would be to have access to more diversified portfolio like this guy right here, even though it has bonds. I'd rather you have more exposure to international and small caps than just all in the S&P 500. Here's the international index. Have everything except the U.S. All right, imagine the fee. Yeah, 0.09. Nothing wrong with that either, man. So it's hard to beat these funds right here. I'm a fan. Let's see. The holdings are. Let's see. It's 97% non-U.S. stocks. Don't tell us that's a world regions, but percent of fund. There you go. So Greater Europe represents 45. Europe developed. It's hard to figure out what that is. Anyway, it's gonna be heavily in the developed market for sure. Let's see if they had Greater Asia. Yeah, so it's gonna be heavily in the developed market: Japan, Australia, Asia, Asia emerging and whatnot. So you will have some emerging market risk in there too, but that also could be returns. So I like it. Russell. All right, so here you go. That's it real quick. Let's just see if they just have one total stock index fund Stable value fund. So here's your stable value fund. Again, another place you want to park some cash right before you get to retire. I'd do this without question. That or the total bond index. This will give you probably less downside risk than the total bond index, but either one, I think, would be in a good place. GICs are guaranteed investment contracts. All right, so that just simply says, look, they're buying some hedging portfolios to make sure the dollar, they don't go below what dollar price for your mutual fund shares, if you will. So it's called break the buck. They don't want a stable value fund to break the buck, go beyond a dollar. So they're buying insurance contracts, which is why it's a little bit more expensive, in which to maintain a level price. That way you don't have to worry about it going, losing 20% overnight or something like that. Not likely to happen in the bond index, not likely to happen in money market, but when they buy these GICs, guaranteed investment contracts, that's what they're doing. They're just making sure that you won't wake up and have 20% decline. Let's see here. A global bond fund. I don't like bonds, so if you're going to buy into bonds, I'd rather have you just did that index fund, all right, that they talked about. We have 30, 30, 40. In fact, let's take a look at that 30, 30, 40 again, because how much of that was global bonds? We got balanced index fund. Does it say international index, S&P? NT, I don't know what that is. Aggregate bond index. Yeah, I'm not sure what that is. So I'm not sure how much of that is foreign bonds or not. If I had one fund, it'd be that one, the index fund, the balanced index fund for sure. All right, let's keep looking. I just want to see if they have a total stock index fund, if they do or they don't. Diversified, here you go. Some real asset fund. Okay, got no problem with that at all. A little bit higher on the expenses because they're doing more to hopefully get you exposure to areas that you aren't in the other aspects of your portfolio. Tips and equities and commodities. So, if you want to add, say, 10% to the real asset fund, man, I have no qualm with that in the least. I have none whatsoever. It's a nice diversification. It really is. It'll give you a nice way to offset your risk of the markets for sure. Let's keep going down. U.S. large companies funds, that's going to be the S&P 500 essentially. I no reason to buy this if you just have the S&P 500 or the balance index. So I just keep the index funds. No reason to have that. Global equity fund. Let's see, a little bit higher expense ratio. Who's the manager? Wellington, there you go. So Wellington runs it. Yeah, I got no problem with that either. Again, I just do the balance index. Now, if I didn't want bonds at all, I would do. Let's gotta see if they have a total stock index. Looks like the International Companies Fund. All right. It looks like it might be. That's about it. And then the small. Okay, here we go. Finally, good night. Who's a manager here? A bunch of different guys. All right, so I like this. All right, so a small and mid companies fund is going to be the equivalent of that Russell 2000 fund, but that's more small caps. So this will have small and mid-sized companies. So I like this. So if I'm buying a true stock index, I'm going to buy the S&P 500 index. I'm going to buy this guy right here, and then I'm going to buy the international index, if that makes sense, or the global equity fund. Those three. And I could probably put 60, 20, 20, 60% in S&P 500, 20% here, and 20% international. They're a little bit more aggressive on international stocks than I would be relative to that balanced index fund. But you got to make sure you have some small cap exposure, my friends. And so the Russell 2000 is fine, but the drawback about the Russell 2000, it is geared more towards a smaller end, and it misses a large chunk of change than mid-sized companies. So I like this better. See some pretty good managers in here. Wellington, Dimensional Fund Advisors as well. So William Blair is a pretty good manager for foreign stocks. So I think are they doing any foreign stuff here? No, I guess not. Okay, so was it William? Yeah, I'm thinking about something else. I don't know. Anyway, but DFA is a good company. Wellington's a good company. Lord Abbott, I've heard of William Blair, but that's fine. So I like this fund right here. It's a little bit more expensive because you are getting some active management in that. And I think there's a value to add in active management on the small cap side for sure. And they invest in both growth and value stocks. So I like that fund quite a bit. I would absolutely consider adding that to my mix. So if I want to just set it and forget it fund, I'm going to balance index without question. I'm done. If I want a aggressive fund, I got to buy three. I'm going to buy the U.S. stock index at 60%, the global index, the global equity index, or the international index, whatever you want to label it as 20%. And then I'm buying this guy, the small and mid-sized stock fund, at another 20%. And that's done. That's it. I'm done. I don't do anything else. Just let it be, and you'll be good to go. If I want one stock fund, it's going to be the balanced index. If I got 2 years out, I'm worried about the market, I'm looking at the stable value fund or the total bond index. Let's see if that's it. And then they got the stock fund as well. Now, nothing wrong with putting 5 to 10% of your portfolio in the total stock, the Boeing stock fund. That anytime you're taking, that's a risk. I mean, there's no other way around it. More risk, potential, much more return. Nothing wrong with doing that. So I'm not going to yell at you if you did that. But that's the investments, man. It's good. I mean, the fees are cheap. Lots of diversification there. Don't need to do much in terms of active. Just set it and forget it and be done. So I hope you find this helpful. If you know people at Boeing who might share this with them for sure. And I hope you find this to be what you're looking for when it comes to the investment options at the Boeing VIP plan. And if you like what we do here, subscribe, smash the like button, and we'll see you next time.